Certain transactions can trigger corporate gain, even though Section 355 can apply, referring specifically to Sections 355D, E, and F. These provisions were added to prevent perceived abuses. Now, to put these provisions into context, an exploration of Section 355C is first in order. Section 355C1 provides a general rule that a corporation shall not recognize gain or loss when it distributes, and Section 355 or Section 356 via 355 applies to the distribution. Note that Section 361 applies in the case of a deed reorganization. Section 355C2 provides that a distribution of appreciated property other than qualified property results in a taxable gain to the corporation. Qualified property is generally stock or securities of controlled distributed corporations. The thrust of 355D is that a distribution to a person that is a 50% or greater shareholder in the controlled or distributing corporation after the distribution will not be a distribution of qualified property to the extent the shareholder purchased that 50% or greater interest within the last 5 years. In other words, the 5 years prior to distribution. Thus, any such distribution can require recognition of gain by the distributing corporation. Some further points with regard to 355D. First, 355D4. A 50% or greater interest refers to stock representing at least 50% of the vote or at least 50% of the value of the outstanding stock. Section 355D5. A. Purchase refers only to transactions where basis is not carryover in whole or in part or is inherited, and sections 351, 354, 355, and 356 don't apply. B. But a Section 351 transaction is a purchase to the extent for cash or cash item, marketable stock or securities or debt of the transferor. And C. If one person has a carryover basis from a purchaser of stock, then that stock is treated as purchased when the original person purchased it. Pursuant to 355D6, the 5-year period is suspended, in essence extended, for periods when there is a substantial diminution of risk. Section 355D7 provides aggregation rules. A. Related persons, and I refer you to sections 267B and 707B1, are treated as one person, and B. Persons acting in concert are treated as one person. Finally, pursuant to section 355D8, attribution rules also apply. 355E provides that generally, stock or securities will not be qualified property if there is a plan for one or more persons to acquire, directly or indirectly, a 50% or greater interest in the distributing corporation or the controlled corporation. If these persons acquire the stock within the period beginning 2 years before and ending 2 years after distribution, a plan is presumed to exist unless the taxpayer can establish otherwise. This is pursuant to section 355E2B. Note that there are exceptions, including section 355E3A i, which can include the possibility, except as might otherwise be provided in regulations, where you get stock in a controlled subsidiary by virtue of holding stock in the distributing corporation. Also, if all companies remain in the same affiliated group, a bad plan does not exist. So, going back to question 4C, while the transaction will generally fall under the protection of section 355 as to A, T will presumably be taxed. Some other points to note about section 355E. If 355D applies, it overrides E. Section 355E also applies generally to asset acquisitions under section 368A1C or D. in which case the historic shareholders of the acquiring corporation, in other words, a corporation acquiring assets, those shareholders are treated as acquiring stock from the corporation from which the assets are acquired. Also note Section 355E is not applicable in a bankruptcy or similar case. And Section 355E4C provides that aggregation and attribution rules apply, the same or similar to the rules under Section 355D described above. Section 355E4E provides for a tolling of the statute of limitations. If a Section 355E distribution occurs, the statute of limitations is tolled, in other words, held in suspense, for any deficiency as a result of such distribution until 3 years after the taxpayer notifies the IRS that such distribution occurred. Section 355F basically precludes Section 355 treatment altogether for distributions between members of an affiliated group pursuant to a plan where one or more persons acquire 50% or more of the stock in the distributing or the controlled corporations. De-reorganizations can fall into one of two categories: divisive de-reorganizations and non-divisive de-reorganizations. We have already covered divisive de-reorganizations, so we now turn our attention to non-divisive de-reorganizations. This would be a reorganization that qualifies under Section 368A1D by virtue of satisfying Section 354 or so much of Section 356 by reference to Section 354. A reorganization will not qualify as a de-reorganization under Section 354 unless the transferor transfers substantially all of its assets to one other corporation that it controls. Then the transferor must distribute the stock and securities of that other corporation as well as its other assets and then liquidate. As can be seen, Section 354 was not designed for dividing corporations. So if you want to divide a corporation, you must qualify under Section 355, which has the devise clause and the separation of two active trader businesses requirement, etc. So obviously, divisive and non-divisive Ds involve two significantly different contexts. A further point on non-divisive D reorgs: the definition of control is markedly different for non-divisive D reorganization pursuant to Section 368A2H. Instead of requiring ownership of stock representing 80% of the voting power as well as 80% of each non-voting class of stock, which is the normal rule under Section 368C, the requirement is relaxed to 50% of the voting power or 50% of the value. Also, attribution is applied for this purpose. I think it's important to note that the possibility of a non-divisive de-reorganization is primarily as a weapon for the government to combat liquidation reincorporation problems. And so, if a taxpayer wishes to liquidate a corporation in an attempt to gain some tax advantage and then reincorporate the assets, beware that the government might characterize that attempt as a non-divisive de-reorg in order to take away the tax advantage. Let's turn to liabilities in a divisive de-reorganization. A de-reorganization involves the transfer of property, but it may also involve the transfer of liabilities. To put this in perspective, note that there is a general rule in the tax law that getting rid of liability is treated as though you received cash and paid off that liability. But Section 357A provides an exception where the transfer of liabilities is generally not treated as the receipt of boot for purposes of computing recognized gain. But if Section 357C applies, an exception to the exception indicates that a transfer of liabilities in excess of the bases of assets transferred will result in recognized gain equal to that excess. Now, while Section 357C generally does not apply to reorganizations, it does apply to a divisive D reorg, but not a non-divisive D reorg. Turning now to judicial restrictions in divisive reorganizations. The same kind of continuity and business purpose doctrines arising in other types of reorganizations arise here, but in different form. First, Regulation 1.368-1B requires a continuity interest by the owners of the enterprise. More specifically, Regulation 1.355-2C1 requires the historic shareholders to maintain some minimum level of equity ownership in the distributing corporation as well as each distributed controlled corporation. It is acceptable for different shareholders to end up with differing interests in the various corporations as long as a certain minimum of equity is owned in each corporation by at least one historic shareholder. If the overall ownership of equity in each of the various corporations falls below some minimum level, then continuity will not be found and the transaction will not qualify under Section 355 or 354. Now, what is that minimum? Well, probably the same, or close to the same standard as for other reorganizations. The Section 355 regulations do provide some guidance. 50% of equity is acceptable, 20% is not, which again is roughly consistent with the standard for normal or other types of reorganizations. Another requirement originally formulated by the courts is a need for business purpose. Note that the requirements for business purpose appear to be much stricter under the Section 355 regulations than for other types of reorgs. Some of the more important points from these regulations. Number one, there must be a real and substantial non-federal tax purpose germane to the business of the corporation. So again, the transaction must have a real and substantial non-federal tax purpose germane to the business of the corporation. Number two, state or local or foreign tax purposes will not qualify as non-federal tax purposes if the state has similar provisions to federal tax law and the federal tax savings are greater or substantially coextensive with the reduction of non-federal taxes. One point I would make here is that oftentimes state taxation piggybacks on federal taxation if the state tax savings is simply because federal taxable income has gone down and therefore state taxable income has gone down, that is not enough. There must be something more than that to satisfy the required business purpose. Number three, a shareholder purpose is not a corporate purpose, although there might be overlapping benefit. For example, feuding shareholders. Resolving disputes between shareholders is a shareholder purpose which would not qualify unless the dispute interferes with the corporate business, in which instance it should be considered a corporate purpose. Number four, there must be a distinct business purpose for the distribution itself. If the distribution does not give rise to a distinct business purpose, if the business purpose for the overall transaction could be adequately accomplished without a distribution, the Section 355 treatment is lost. For example, if the purpose for the transaction is to insulate the assets of a non-risky business from a risky business, could that purpose be sufficiently served by just dropping down the risky business to a subsidiary? If yes, then that would not satisfy the business purpose requirement. And so you have to ask, well, what more is gained by also distributing the subs? Not only have you dropped down to a sub, but again, what more is gained by also distributing the sub? Now, to be clear, there might be further advantage to distributing the sub, but that is something that must be determined. And number five, a transaction done in order to allow one corporation to elect S status is not a business purpose. Question 5, illustrated in the diagram before you. A and B, both individuals, each own 50% of X. X owns S, worth 100, which has a COG business which S has actively conducted for 10 years. X has a widget business which it has actively conducted for 25 years. X also has earnings and profits of 120. X distributes S and cash of 10 to each A and B. What are the consequences of this transaction? Well, this is a spin-off. Both distributing and controlled corporations have active trades or businesses afterwards, and all stock and securities of S have been distributed. So to this point in the logic, this would be a good Section 355 transaction. But boot is received, and so technically this is not good under Section 355. Now what? Well, we look to Section 356. More particularly, we look to Section 356B, which indicates that the boot is treated as a distribution under Section 301. Now, to be clear, we look to 356 if the transaction would have qualified under 355 but for the receipt of boot, right? Which, again, appears to be the case here. And again, more particularly, we look at 356B, which treats the boot as a distribution under Section 301 in the case of a spinoff. Here, the cash for 20 will be treated as a dividend because there is more than enough E&P. The distribution of S stock is not a dividend, however, even though adequate E&P. The distribution of this stock is protected under Section 356 via Section 355. We've already discussed the provisions of basis and holding period as regards other types of reorganizations. These provisions are equally applicable to dereorganizations. One special situation does, however, deserve analysis. In question 6, presented to you on the diagram, an individual owns 100% of X. X owns two businesses, a widget business and a cog business. Both businesses have been actively conducted for 25 years. The widget business has assets with a basis of 30 and a fair market value of 100. The cog business has assets with a basis of 50 and a fair market value of 100. X transfers the cog business to NewCo in exchange for 100% of NewCo stock. X then distributes the NewCo stock to A. Assume that A has a basis in X of 100. Assume that X has an NOL carryover of 100 expiring next year. Assume that the transaction is not a device. What are all the consequences except the impact on E&P on all the parties? Well, the first thing to note is that this is a garden variety dereorganization qualifying under Section 355. So in other words, a divisive dereorganization. And so this question is designed to bring out the consequences of a divisive dereorganization. Turning our attention first to A is protected under Section 355. A received solely stock or securities in a controlled corporation. Under Reg 1.358-2A2, A allocates basis in X between X and NewCo. Allocates based on relative fair market value of the two companies. A's basis of 100 will therefore be split 50-50, 50 to X, 50 to NewCo, based on the relative fair market values of 100 and 100. X has the widget business worth 100. NewCo has the cog business worth 200 less liabilities of 100 for a net fair market value of 100. Before moving on, let me emphasize this basis result. This might actually be the most common issue that one might face in practice. A client owns stock in a public company which has spun off a sub. What basis does that client have in each of the parent and the sub afterwards? Well, this Reg 1.358-2A2 addresses that issue. How does one determine the fair market values of the companies? Well, if the company is publicly traded, you could look it up. Better yet, in the context of publicly traded stocks, the parent's website will often have an investor relations tab, and under that tab, the company will often provide the analysis for you. And so they will break out, allocate this percentage of your original basis to the parent, allocate this percentage to the sub. Turning to X, 361A provides that no gain or loss is recognized on the transfer of property. Next, we turn to the effect on NewCo. First, Section 1032 protects NewCo from gain or loss. All NewCo has done here really is issued its stock, and again, 1032 would say NewCo does not have gain or loss on its stock. What basis will NewCo have in the assets acquired? Section 362B provides a basis equal to a carryover basis plus gain recognized by the transferor was no gain recognized by a transferor, and so here there will be a carryover basis of 50. Turning to the carryover of corporate attributes. While Section 381 applies to reorganizations qualifying under Section 354, 381 does not apply to divisions, even if the division includes the divisive reorg. In other words, a reorganization qualifying under Section 368A1D by virtue of qualifying under Section 355. And so generally, NOLs, credits, and other items of the old company's tax history do not carry over to the new company. These attributes stay with the old company. The new company starts with a clean slate. But there is an exception, and that exception is for E&P. Section 312H provides that E&P is allocated between the old and new companies. And for newly created corporations, this allocation is generally done in accord with relative fair market values of the assets of the two companies. Note there is no allocation of a deficit in E&P. In question 6b, X has E&P of 120. Does NewCo have any NOLs or E&P as a result of this transaction? Well, the NOLs will stay with X. None are allocated to NewCo. Section 381 is not applicable to this divisive reorg. E&P is presumably split 50-50. X ends up with 60 and NewCo ends up with 60, based on the relative fair market values of assets retained and transferred. If a reorganization is not involved, the distributing corporation's E&P goes down by the lesser of two amounts. First, a decrease as though stock of controlled corporation was hypothetically dropped down to NewCo, and NewCo is then distributed in a hypothetical reorganization. And the second amount, the net worth of the controlled corporation. Normally, without a reorganization, there would be no provision for changing the controlled corporation's E&P. But the regulations can change that normal rule. If the controlled corporation's E&P before the transaction is less than the amount of the distributing corporation's decrease, then the controlled corporation's E&P shall equal such decrease, in other words, reset to equal such decrease. If alternatively, the controlled corporation's E&P before the transaction is more than the distributing corporation's E&P, then you don't change the controlled corporation's E&P. And in any case, you don't allocate any part of a deficit in E&P to the controlled corporation. Finally, let's consider the tax consequences of busted divisive reorganizations. Let's say, for example, that the transaction doesn't qualify under 355 because of the device clause, or maybe there's some other violation. Well, for a busted spinoff, you treat it as a 301 distribution, Section 301 distribution. Note that an initial transfer to a corporation won't be a reorganization, but could qualify under Section 351, at least potentially. Also note that Section 311B will now normally apply to the corporation on the distribution of appreciated assets. In the case of a busted split-off, you treat it as a redemption under Section 302. Again, note an initial transfer to a controlled corporation won't be a reorganization, but could qualify potentially under Section 351. And again, note that Section 311B will now normally apply to the corporation in the case of the distribution of an appreciated asset. Finally, for a busted split-up, you would generally treat this under Section 331 as a taxable liquidation. Again, look to Section 351 for a drop-down, and note that Section 336, subjecting the liquidating corporation to gain or loss when it liquidates. Also note that if a transaction fails to qualify under Section 355 because it is a disguised distribution, then simply treat it as a distribution.